Welcome. We're going to continue with our comprehensive example. We're almost done. We've gotten to the exciting part where we're going to start making financial statements. In this video, I'm going to talk about making an income statement. Remember, the income statement's the statement that answers what happened over some period of time. Now, making an income statement's pretty straightforward at this point. Remember, we've already summed up everything in the revenue and expense accounts during the closing process. So really, all that we need to do now is take that summarized activity and put the accounts into a format that makes them the most useful to decision makers. That means expenses get combined with other similar expenses to form expense categories on the income statement. This is a reminder. We've talked about the income statement before, but let's just quickly run through its format. We start with revenue. That's the value that comes into the firm. We subtract out the cost of goods sold, those really direct costs, to get gross profit. Then we take out the selling, general, and administrative expenses. Next, we take out the other operational expenses. Once we've done all of that, we're down to operating profit. Then the firm may have some other income or expenses, like taxes or some other item like that. Or there may be a few gain and loss adjustments, and we'll talk about those in future videos. And finally, we'll get to net income. Now let's take this format and apply it to our comprehensive example. So we start by recognizing the fact that we had revenues of $225,000. Remember, those were the sales we made to outsiders. And to get those revenues, we had to give up items that had cost us $140,000. Those are the books we'd purchased from other people. That left us with a gross profit of $85,000. This gross profit is the amount we've made based on the value we brought in, less what it cost us directly to create that value. Now in this example, we're a wholesaler, so we purchased those books. We didn't do anything to manufacture them. So it's mostly just the costs that we paid other people, plus maybe there could have been a few other small costs. In our example, we didn't have those. People often focus on gross profit because it gives us some sense of how much value can you drive from your basic business. However, remember that we did have other expenses that were also part of operating. We had our wages, our employees we needed to sell the books. We had our rent, we needed the warehouse to keep them in, and we had our depreciation. Those sum to another $10,000 of operating expenses. Without these expenses, we wouldn't have been able to make those sales. Think about it. If we just purchased these books and thrown them out in a field and hoped that somebody would realize they wanted them and come and get them and actually promise to pay us, etc., that wouldn't really work. So we call these operating expenses because there's still things we need to do to operate our company. Now, if you think back to that earlier slide, there might be something below these operating expenses if we'd had taxes, for example, to put in here, or if we'd had some sort of other impact on our financial statements not related to our base operations. In our simple example, we didn't have that, so we can just sum to our net income, which is our total revenue that came in, less our cost of goods sold, and all those other operating expenses. This number represents the net value that we've created. That is, the value that we bring in less all the value it took to generate it, and in this case, that's resulted in a $75,000 increase in net value for our firm. Okay, now that we know what the income statement looks like for this company, let's think about how we could use it to actually help understand our business. Remember, that's the goal of accounting, to provide information to decision makers. Well, one question that we might ask ourselves is how much of each sale does an owner get to keep? Now, if you're asking that question, really, you're just focusing on revenue and net income. We're kind of ignoring everything in between there and saying if we bring in a certain amount of value through a sale, how much of that, once we're done with all the things we have to use up to create value, does an owner actually get to keep? To do that, we might want to create a ratio. I'm going to call this ratio return on sales. We can take net income and divide it through by revenue. Maybe you've seen this with a different name. That's okay. We're going to do a couple videos on ratios, and I'll point out we don't want to get too hung up on the names. What we really want to understand is how we put the information together to answer questions. Or maybe you've seen return on sales, but it was calculated a little different way. That's okay too. For the question we're trying to answer, it makes perfect sense to put net income over revenue to try to figure out how much of the revenue does an owner actually get to keep. So we take our $75,000 of net income and we divide that by the fact that we had $225,000 of sales. When we do that, it turns out that 33 cents on every dollar is kept by the owners. That is, when we make a sale, the owners are able to keep 33 cents of it, and 67 cents is used up in other expenses, whether that's what it costs us to purchase the books, to have the warehouse, to pay our employees, etc. To be honest, 33 cents is a pretty high return on sales, but since I was making the example, I figured I might as well make it a good company. That's just one type of answer that we can give with an income statement. If you take a look at the income statement, you realize there's a lot of other information in there. If you had other questions about what happened over time, we could pull that information off the income statement, either just using one line item or combining line items like that to further answer our questions. I'm not going to dig into those now. As we go through future videos, you'll develop a lot better understanding of what sort of information we can pull out of these. But before we move on, I do want to point one thing out to you. Notice there were no dividends on the income statement. Even though we paid dividends of $12,000, they didn't show up anywhere on that income statement. The income statement captures value creation and destruction through interactions with entities outside the firm. Owners are not outside the firm. They're part of it. Since they're not outsiders, they shouldn't impact the income statement. Any interactions the firm has with owners moving value in or out of the firm is really just the owners moving value from one of their assets, say their bank account, into the firm, which is another one of their assets, or moving it out of one of their assets, the firm, and back into their bank account, which is the case with dividends. So we don't want to think of that as something that's created or destroyed value through interactions with outsiders, and we leave it off of our income statement. Again, dividends do not go on the income statement. We're going to cover this again in another video. You're probably wondering why I'm making such a big deal out of this. If I could add up the top 2 or 3 mistakes my students make, putting dividends on the income statement is definitely one of the big ones. And it's really a silly one that we shouldn't have to worry about. Some of you, even after all of this, are still going to break my heart and do it, but I'm doing my best to really make this point to you. Please don't put the dividends on the income statement.